One envelope, that's all it takes. No emergency meeting, no warning call from the bank. Just a thin white letter waiting on your kitchen counter beside a bag of groceries and an unpaid hydro bill. You open it casually at first, and then your stomach drops. Because the number staring back at you doesn't just change your mortgage, it changes your entire life. A payment that used to feel manageable in 2021 has suddenly exploded in 2026. Not because you missed payments, not because you lost your job, but because one number changed behind the scenes, interest rates. And over the next 12 months, more than 1 million Canadian families are about to experience the exact same shock. Some will survive it, others will quietly lose the financial life they spent years building. This is the mortgage renewal cliff. And by the end of this video, you'll understand exactly why it's happening, who created it, and the 5 moves that could save you tens of thousands of dollars before that letter arrives. It arrives on a Tuesday afternoon in 2026, a plain white. Envelope slides through the mail slot without ceremony, no urgency, no red stamp, nothing dramatic. Just paper. It lands quietly on the kitchen floor. For a few hours, nobody touches it. Dinner gets cooked. Groceries get unpacked. Someone complains about gas prices. A kid asks where their hockey jersey is. Life continues exactly as it did yesterday. Then somebody notices the logo in the top corner, the bank. Suddenly, the envelope feels heavier. You bring it to the kitchen table, sit down slowly, tear it open carefully, almost like your brain already knows what's waiting inside. And there it is, mortgage, renewal notice. 5 years ago, this letter would have meant nothing. Back in 2021, money was cheap. Interest rates felt almost unreal. People locked in mortgages at 1.5%, maybe 1.79%, maybe just above 2%. At the time, it felt normal. Looking back now, it feels like a different universe. Those low payments became part of life so quickly that most families stopped thinking about the mortgage entirely. They bought homes, renovated basements, took trips to Mexico during winter, upgraded cars, added monthly subscriptions without checking the total. The mortgage payment stayed fixed like a concrete pillar holding the entire household together. Predictable, stable, safe. But now it's 2026, and halfway down the page sits a new number, 5%, maybe 4.79, maybe over 5%. The exact percentage almost doesn't matter anymore, because your eyes skip past the rate and land directly on the line underneath it. The new monthly payment. You read it once, then again, then a third time because your brain refuses to believe what it's seeing. Almost $600 more every month. Not for a bigger house, not for a renovation, not for a vacation, just to stay exactly where you already are. And in that moment, something changes psychologically for millions of Canadians all at once. The house didn't change. Your job didn't change. Your family didn't change. One number changed, and suddenly the future feels smaller. This is the renewal cliff, and in 2026, more than 1.2 million Canadian households are walking toward it, whether they realize it yet or not. To understand how brutal this really is, we need to slow the numbers down, because statistics on television sound abstract, but mortgage payments are not abstract when they come out of your bank account every month. So let's imagine a completely ordinary Canadian family, not wealthy, not reckless, just normal. Maybe they bought a townhouse outside Toronto, maybe a semi-detached home in Calgary, maybe a bungalow near Halifax. Different city, same story. In the spring of 2021, they borrowed $400,000. At the time, interest rates were unbelievably low. They locked into a 5-year fixed mortgage at 1.5% with a 25-year amortization. Their monthly payment came to roughly $1,590, and for 5 straight years, that number never moved. Meanwhile, everything else did. Groceries climbed higher every few months. Gas prices jumped. Daycare costs exploded. Property taxes rose quietly in the background. Insurance crept upward. Restaurants became noticeably more expensive, but the mortgage payment stayed frozen in time. That stability created confidence. Confidence created spending. Families adjusted their entire lifestyle around the assumption that housing costs would remain manageable. And then came renewal. Now fast forward to 2026. The family still owns the same house, same driveway, same kitchen table, same family photos on the wall, but their remaining mortgage balance is now around $345,000, and this time the renewal rate is no longer 1.5%, it's 4.5%. Suddenly the new monthly payment becomes approximately $2,198. Pause there. For a second, that is nearly $600 more every single month. So 9.599 219 plus 599 for 219 play 599 2198 not once, not temporarily. Every month for the next 5 years. That's $7,280 per year in additional after-tax money disappearing from the household budget. A 999 toy 71 the 88590 times 12 years 71 d 8,9 to 718 over an entire 5-year term. Nearly $36,000 gone. Yin with X5 or 359 407 and times 5 or 359 407 X5 359 for you. And remember, this example is considered modest in modern Canada. In cities like Toronto or Vancouver, many families carry mortgage balances between $700,000 and $950,000. At those levels, the increase can exceed $1,000 per month. Imagine watching an entire second rent payment suddenly appear inside your own home budget. That's what renewal shock feels like. And the most disturbing part? Nothing about the family became more irresponsible. They didn't suddenly overspend. They didn't gamble money away. They didn't lose the house through recklessness. The financial structure underneath them simply changed. One interest rate, signature from 5 years ago, one letter from the bank. And just like that, an ordinary middle-class life becomes dramatically more expensive overnight. Every financial disaster has a villain. Sometimes it's obvious. Sometimes it hides behind policy meetings, spreadsheets, and carefully chosen language. In Canada's 2026 mortgage crisis, there are 3, and the first one operates from office towers in Ottawa. Villain number 1, the Bank of Canada. Now, technically, the Bank of Canada is not trying to destroy households. Its official job is simple: keep inflation under control. But intentions do not change outcomes, because the same institution that flooded the economy with emergency low rates in 2020 and 2021 later slammed the brakes harder and faster than almost anyone expected. Back in March 2020, the overnight rate dropped to 0.25%. Money became incredibly cheap. Borrowing exploded. Home prices surged. Families rushed into the market, terrified they would be priced out forever. And for a while, it worked beautifully until inflation arrived like a wildfire. By 2022, the Bank of Canada began hiking rates aggressively. Then again. Each announcement added pressure silently inside millions of mortgages across the country. By mid-2023, rates had climbed to 5%, the fastest rate hiking cycle in modern Canadian history. And now, in 2026, those decisions are finally arriving at kitchen tables all across the country in the form of renewal notices. The families who borrowed at the absolute bottom of the rate cycle are now renewing near the top, and they're the ones absorbing the impact. But the second villain is even more ironic, because Canadians were actually warned this could happen. They just didn't realize the warning would become reality. Villain number 2, the mortgage stress test. Back in 2021, almost every borrower had to pass something called the B20 stress test before getting approved. The rule sounded ridiculous at the time. Even if your mortgage rate was only 1.5%, regulators forced you to prove you could still afford payments at a much higher rate, usually around 5.25%. Most people hated it. Buyers complained. Brokers complained. Families felt punished for no reason. People kept asking the same question: if I'm paying 1.5%, why do I need to qualify at 5.25%? The answer in 2021 sounded hypothetical. Now it sounds prophetic, because in 2026, that imaginary disaster scenario has become the real monthly payment. Percent 5, 25% 15%, right arrow 5, 25% 15, 25%. The stress test was never random bureaucracy. It was preparation for exactly this moment. And now millions of Canadians are discovering something painful. Passing a stress test on paper does not mean living through it emotionally feels manageable, especially when the numbers finally become real, especially when the higher payment stops being theoretical and starts leaving your account every 30 days. The regulator predicted the storm, but prediction doesn't soften impact. And for many households, the hardest part is realizing the system warned them years before the letter ever arrived. But the third villain in this story is the strangest one, because many Canadians didn't even realize it was happening until years later. Villain number 3, negative amortization. And if you had a variable rate mortgage during 2022 and 2023, this is where the story becomes truly surreal. Here's how most people think a mortgage works. You make payments every month. the balance slowly goes down, and over time, you own more and more of your home. Simple. Except during Canada's rate shock, that stopped being true for hundreds of thousands of homeowners. Many variable rate mortgages at the big banks came with fixed monthly payments. The payment amount stayed the same, but the interest portion inside that payment floated with interest rates. At first, the changes were manageable. Then rates kept climbing and climbing and climbing. Eventually, something bizarre happened. The interest owed each month became larger than the actual mortgage payment itself. Think about that carefully. The entire monthly payment was no longer enough to even cover the interest. So what happened to the unpaid portion? The bank quietly added it back onto the mortgage balance, meaning families were paying every month on time, in full. And their debt was still growing. That is negative amortization, one of the most financially disorienting experiences a homeowner can go through. Some Canadian households in 2023 and 2024 opened their mortgage statements and discovered they owed more money than they did years earlier, despite never missing a payment. Imagine the psychological shock of that moment. You followed the rules. You paid every month. You did everything correctly, and somehow the debt got bigger anyway. For an entire generation of homeowners, it shattered a basic assumption about adulthood. Paying your bills does not always mean paying down your debt. Now fast forward to Renewal. In 2026, these families are getting hit twice. First, many owe a larger principal balance than they originally expected. Second, they are renewing that larger balance at rates roughly 3 percentage points higher than where they started. It's financial gravity working in reverse. And this is where the crisis stops feeling theoretical, because an extra $600 per month is not just less savings. It's lifestyle compression. It's the quiet shrinking of normal middle-class life. That extra money used to fund Friday dinners out, kids' hockey registration, streaming subscriptions, weekend trips, Costco runs that didn't require calculator. Math. Now that same money gets rerouted directly into interest payments. And the families experiencing this are not irresponsible people. They are teachers, nurses, electricians, software developers, small business owners, federal employees, people who saved for down payments, qualified legally, made every payment on time. And yet, despite doing everything correctly, many are discovering that the same income which comfortably supported a household in 2021 suddenly feels tight in 2026. Not because life became luxurious, because survival became more expensive, and the squeeze doesn't arrive dramatically. That's what makes it dangerous. There's no single catastrophic moment where everything collapses overnight. No alarms, no movie scene, just small decisions quietly stacking on top of each other month after month. The family eats out less often. Then they cancel one streaming subscription, then another. The spring vacation gets postponed just for this year. The kitchen renovation gets pushed into the future. The second car suddenly feels unnecessary. The kids hear the phrase, "we'll see," more than they used to. And slowly, almost invisibly, the standard of living contracts. This is what economists politely call demand destruction. That's the technical term, demand destruction. But at the kitchen table, it feels very different. It feels like saying no more often. No to dinners out. No to travel. No to upgrades. No to things that once felt normal. And here's the uncomfortable truth most people never hear clearly. This squeeze is not an accidental side effect of fighting inflation. The squeeze is the strategy. When the Bank of Canada raises interest rates, the goal is not just to lower inflation numbers on a spreadsheet. The goal is to reduce consumer spending in the real world, which means your reduced spending is part of the policy working exactly as intended. That's the mechanism. Millions of households renew at higher payments. Disposable income disappears. Families cut spending. Businesses feel demand weaken. Inflation slows. It sounds clean in economic theory, but in reality, it happens one stressed household at a time, one canceled vacation at a time, one grocery budget at a time, and multiplied across more than 1.2 million Canadian mortgage renewals. In 2026, the effect becomes enormous. Restaurants feel it first. Then car dealerships, then furniture stores, home improvement chains, travel companies. Small businesses. The renewal cliff stops being a housing story and starts becoming an economic event, because what's happening isn't just a mortgage reset, it's a nationwide transfer of spending power away from middle-class households and toward debt servicing. And right when families become desperate for relief, the banks arrive with a solution that sounds comforting at first, dangerously comforting. You call your lender in panic after seeing the new payment amount. The voice on the phone stays calm, reassuring, professional, and then they offer you a way to lower the payment. Extend the amortization. Your original mortgage may have been set to finish in 25 years. By 2026, maybe you have 20 years remaining, but now the bank offers another option. Why don't we stretch it back out? 30 years, 35 years, maybe even 40. Suddenly the payment drops again. Relief floods your nervous system instantly. The number starts looking manageable. The crisis appears solved. But this is the moment where many Canadians unknowingly walk into the most expensive financial trap of their entire lives, because the 40-year amortization is not a rescue plan, it's a trade. Brutal one. And most people never stop long enough to calculate the real cost. Let's go back to that same household. They still owe roughly $345,000 at renewal in 2026. At a 4.5% interest rate with 20 years remaining, their payment sits around $2,198 per month. Painful, but mathematically honest. Then the bank offers the alternative. Stretch the amortization all the way to 40 years. Suddenly the payment falls dramatically. You're back near the level they were paying. In 2021, the relief feels immediate. For a moment, it almost feels like the crisis disappeared. But financially, the damage has only been delayed, because over a full 40-year amortization at 4.5%, the total interest paid on that same loan becomes staggering. More than $10,000 in interest alone. Pause and absorb that number. You borrowed $340,000 and end up paying the bank over $400,000 just in interest. Thousand, throw 5,000 for 1,000. 345,000 for 1,000, throw 5,000. You literally pay more in interest than the original loan itself. Compare that to keeping the original 20-year amortization. At the same rate, total interest would be closer to roughly $176,000. That means the 40-year extension can cost an additional $234,000 purely in extra interest payments. 17,600, 24,000 for 1,000. 17,600, 23,4,000 for 1,000. 17,600, 234,000, almost $250,000. Not for a renovation, not for a second property, not for luxury, just to reduce today's monthly discomfort. This is why the extension feels so seductive. Human beings naturally optimize for immediate pain relief. We want the lower payment now because the stress feels unbearable now, but mortgages punish short-term thinking brutally over time. And there's another problem most borrowers never notice until years later. Equity growth almost disappears. In the early years of a 40-year mortgage, the overwhelming majority of your payment goes toward interest. The principal barely moves, meaning after years of payments, your ownership stake in the home grows painfully slowly. So if life changes, divorce, relocation, job loss, downsizing, many families discover they built far less wealth than expected. Despite years of paying faithfully every month, the extension doesn't just increase interest, it weakens the primary wealth-building engine that middle-class Canadians historically relied on. Home equity. That's why the 40-year amortization is so dangerous. It doesn't feel like debt, it feels like relief, but in reality, it quietly transforms homeowners into long-term interest renters inside their own property. The pain today shrinks. Cost tomorrow explodes. And once you understand that trade clearly, the conversation around mortgage renewal changes completely, because now the question is no longer, how do I lower the payment? The real question becomes, how do I survive this without sacrificing my financial future? So what do you actually do? Not theoretically, not emotionally, practically, because whether your renewal is 6 months away, already sitting on the counter, or still a year out, the decisions you make before renewal matter far more than the decisions you make after the panic starts. And the first strategy is painfully simple. Attack the principal now. If you are still inside your current mortgage term, every extra dollar you put against the principal before renewal becomes incredibly powerful. Why? Because that money never gets re-amortized at higher interest rates later, most Canadian mortgages allow annual prepayments between 10% and 20% of the original balance without penalty. Almost nobody fully uses this feature, but they should. A relatively small lump sum changes the math more than people realize. An extra $5,000 paid against the principal before renewal doesn't just save $5,000. Over the life of the mortgage, it can save 2 to 3 times that amount in future interest. 5,000, 1,000 to 12,500 and 1,500 to right arrow 1,000 rate text to 12,500 and 5,000, 1,000 to 12,500. That's because every dollar removed today avoids compounding interest tomorrow, and compounding works both ways. It builds wealth when you invest. It destroys wealth when debt compounds against you. Strategy number 2, never sign the first renewal letter. This may be the most financially valuable sentence in the entire video. The letter your bank sends you is not a favor. It is an opening negotiation, and many Canadians make a costly mistake right here. They assume loyalty gets rewarded. They assume staying with the same bank automatically means receiving the best possible rate. Usually it doesn't. Banks know most people fear paperwork, switching lenders, and financial conversations, so they rely on inertia. Convenience becomes profitable. That's why shopping your renewal matters so much. Call a mortgage broker, get multiple quotes, then take the best offer back to your existing lender and force them to compete. Because in many cases, the difference between the posted renewal rate and the best available market rate can be shockingly large. Even a difference of 0.5% matters enormously on a 6-figure loan balance. Over 5 years, that gap can equal tens of thousands of dollars in unnecessary interest. 5% throw for $5,000, 5% or times 3, 4, 5,000, percent for 5,000s. One phone call can literally outperform months of budgeting discipline. Think about that. People spend entire years cutting coffee purchases and canceling subscriptions while ignoring the single largest interest negotiation in their financial life. Shopping your renewal is not optional in 2026. It's survival math. And the households that understand this early gain something incredibly valuable before the renewal letter even arrives: leverage. Because the moment you stop acting desperate, banks stop negotiating from a position of total control. Strategy number 3 is the most overlooked advantage in the entire Canadian mortgage system, and almost nobody talks about it: the renewal lump sum. In Canada, renewal day is unique because it's one of the only moments in your mortgage life where you can usually throw a massive amount of money directly against the principal with no penalty whatsoever. Unlimited, no prepayment cap, no percentage restriction, no punishment for paying debt down faster, and yet most homeowners let that moment pass unused. Think about how powerful that actually is. Maybe over the last 5 years, you received a work bonus, an inheritance, a tax refund. Maybe you sold investments. Maybe you simply built savings quietly while rates were still low. Most people look at that money and think about upgrading life. The financially strategic households look at renewal and think differently. Because every dollar applied directly to principal at renewal immediately reduces the amount being re-amortized at higher interest rates, and the long-term savings become enormous. A $20,000 lump sum payment at renewal can easily save somewhere between $9,000 and $12,000 in interest during just the next 5-year term alone. 2,000, 9,000 to 12,000, 2,000, hair right arrow 9,000 to text to the 12,000, 2,000, 9,000 to 12,000. That's an almost impossible guaranteed return to find anywhere else safely. No stock picking, no speculation, no timing the market, just removing future interest before it compounds against you. Now, strategy number 4 may be the most important emotionally, because this is where panic causes people to make dangerous decisions. When the renewal payment suddenly spikes, many households instinctively reach for their HELOC, the home equity line of credit. It feels logical at first, just borrow temporarily to ease the pressure. But this is where debt starts quietly feeding debt. A HELOC is still borrowed money, usually variable rate borrowed money, secured by the exact same house that already became harder to afford. So now the family begins using one form of housing debt to subsidize another form of housing debt. Financially, it's like trying to stop a leak by drilling another hole beside it, and the psychological danger is even worse, because HELOC borrowing delays reality. It creates the illusion that the budget still works, when in truth the household is slowly becoming more leveraged every month. If the renewal payment genuinely cannot fit inside the family's income without borrowing, the real conversation is no longer about the mortgage product. It's about the house itself. That's the conversation nobody wants to have, because for many Canadians, the home is not just financial, it's emotional, it's identity, stability, achievement, security, which is why people will often sacrifice years of future financial health just to avoid admitting the house may no longer fit the numbers. But denial financed through debt rarely ends gently, and the earlier households confront reality honestly, the more options they usually still have left. And finally, strategy number 5, the one that sounds the hardest emotionally, but may protect the most wealth long term. Hold the line on amortization. If your bank offers to stretch your mortgage back out to 35 or 40 years, resist the temptation to immediately say yes, because the lower payment feels comforting today, precisely because the real cost gets pushed decades into the future. And future pain is easy to underestimate. Now, that doesn't mean every homeowner should blindly choose the highest payment possible. Sometimes flexibility matters, sometimes survival matters. But there's a difference between temporary breathing room and permanently restructuring your financial future around endless interest payments. In some cases, taking a shorter renewal term, maybe 3 years instead of 5, can make more sense if you believe rates may eventually fall again. The key is remaining intentional, not reactive, because panic is expensive and mortgage renewals are one of the few financial moments where emotions alone can quietly cost families hundreds of thousands of dollars. The households that survive renewal best are usually not the highest earners. They're the households willing to confront the math honestly before desperation takes over. And now, let's go back to the kitchen. The letter is still sitting there on the counter. Same white envelope, same cold numbers, same shock, but something is different now. You understand what happened. You understand how ultra-low rates in 2021 created today's payment shock. You understand why the stress test turned out to be a warning instead of an inconvenience. You understand how negative amortization trapped variable rate borrowers in a system where paying monthly didn't always reduce debt. And most importantly, you understand why some of the solutions being offered may quietly create even bigger problems later. Because the renewal cliff is real, the payment shock is real, and the transfer of wealth from ordinary households toward interest payments in 2026 is one of the biggest financial shifts many Canadian families will ever experience personally. But information changes behavior. And behavior changes outcomes. The families who wait until the renewal notice arrives often negotiate from fear. The families who prepare early negotiate from strategy. That difference matters more than most people realize, because renewal isn't just a math problem. It's a psychological one. Fear makes people freeze. Stress makes people accept bad terms. Urgency makes expensive decisions feel reasonable, but preparation creates leverage, and leverage creates options. So when that letter finally lands on the kitchen counter, the goal is not to feel surprised. The goal is to already have a plan moving before the envelope even gets opened. That is the difference between a household that absorbs the renewal shock and in a household quietly pushed backwards financially for the next 20 years. The letter is coming either way. The rates are already set. The only remaining variable is how prepared you are before the envelope arrives. If you found this helpful, subscribe to the channel and share this with someone renewing soon, because in 2026, understanding the math early may be one of the most valuable financial advantages left for the middle class. There's something unsettling about the way this all happens. Nothing dramatic, no collapse, no single moment where everything breaks. Just a letter, a number, and a new version of reality quietly replacing the old one. For some households, the renewal will feel like pressure, but manageable. For others, it will feel like a turning point they didn't see coming. And for a smaller group, it will force decisions they never imagined making about the home they thought would always be theirs. That's the real weight of 2026. Not just higher payments, but tighter choices. Because once your monthly housing cost shifts, everything else shifts with it. What you eat, where you travel, how you spend weekends, what you say yes to, and what you quietly start saying no to. And yet, even inside all of this, there's an important truth that often gets missed. The system isn't random, the math isn't hidden, and the warning signs were never really invisible. They were just easy to ignore when money was cheap and life felt stable. But now, with rates higher and renewals approaching, ignoring the numbers is no longer an option. So the real question is no longer, what will the bank do? The real question is, what will you do before the bank decides for you? Because that's where control actually lives in this story, not in the letter, not in the interest rate, not even in the policy decisions made years ago, but in the months leading up to the moment that envelope arrives. And that's the part most people underestimate. Preparation doesn't remove the shock, but it changes how much damage the shock can actually do. And in a year like 2026, that difference is everything, because two families can receive the same letter, see the same number, and live completely different financial futures afterward. One reacts, the other prepares. And in the end, that's the only real divide this story creates. If this made you think differently about mortgage renewal, hit like, subscribe, and I'll see you in the next breakdown.